Imagine this. You land in Japan with $100 in your pocket. You exchange it, and suddenly you have over 15,000 yen. You feel rich. But then you fly to Kuwait. You exchange $100, and you get just 30 Kuwaiti dinars. Now you feel poor. Same $100. Completely different numbers. So what's going on? Why is one currency worth 150 times another? Why is the Kuwaiti dinar stronger than the US dollar? Why is the Japanese yen so weak in numbers, but Japan is one of the richest countries in the world? And why can't every country just make its currency equal to the dollar? Today we're breaking down the simple, but powerful, economics behind currency values. Let's begin. First, let's clear up a massive misunderstanding. When people say a currency is strong, they usually mean $1 equals 0.30 dinars, $1 equals 150 yen, $1 equals 280 Pakistani rupees. But the number itself means almost nothing. Currency value is simply the price of one currency compared to another. That's it. It's not a grade. It's not a ranking. It's not a scorecard of how good a country is. It's a price. Just like the price of gold, oil, or wheat, and like any price in the world, it's determined by supply and demand. There's a global marketplace where currencies are traded every second. It's called the foreign exchange market, or Forex. Trillions of dollars move through it daily. Governments, banks, investors, businesses, even tourists are constantly buying and selling currencies. And here's the rule. If more people want a currency, then its value rises. If fewer people want it, then its value falls. Simple. But what makes people want a currency? That's where things get interesting. Let's say you want to buy oil from Kuwait. To pay Kuwait, you need Kuwaiti dinars. So you sell your dollars and buy dinars. Now imagine thousands of companies doing this every day. Demand for dinars rises. Its value increases. Countries that export valuable goods, oil, technology, machinery, often see strong demand for their currency. For example, Japan exports cars and electronics, Germany exports machinery, the US exports technology and services. The more the world buys from you, the more the world needs your currency. That pushes your currency up. Now imagine two countries. Country A offers 2% interest. Country B offers 8% interest. Investors want higher returns, so they sell Country A's currency and buy Country B's currency to invest there. More demand equals higher currency value. This is why central banks are so powerful. When the Federal Reserve raises interest rates, the dollar often strengthens. When the Bank of Japan keeps rates low, the yen often weakens. Interest rates attract global money, and global money moves currencies. Inflation slowly reduces purchasing power. If a country prints too much money, prices rise. And when prices rise too fast, people lose confidence in the currency. Imagine you're holding money that loses 20% of its value every year. Would you keep it? Of course not. You'd exchange it for something more stable, like dollars, euros, or gold. This is why countries with high inflation often see their currencies collapse, because trust disappears. And currency value is built on trust. Investors care about safety. If a country has political stability, strong institutions, reliable laws, low corruption, investors feel safe holding its currency. That's one reason the Swiss franc is considered strong. Switzerland is politically stable, financially disciplined, globally trusted. So during global crises, investors run toward the Swiss franc, not because of the number, because of trust. Let's talk about Japan. One US dollar, approximately 150 Japanese yen. That sounds weak. But Japan is the world's third largest economy. So why doesn't Japan just change the value? Because the number doesn't matter. Japan could redenominate tomorrow. They could say 100 yen equals 1 new yen. Suddenly, $1 would equal 1.5 yen. Does that change Japan's economy? Not at all. It's just moving decimal points. Currency value isn't about how many zeros you have. It's about purchasing power and global demand. The Kuwaiti dinar is one of the highest valued currencies in the world. Why? Kuwait exports massive amounts of oil. It has a small population, high revenue per citizen, controlled money supply. Strong export income plus limited currency supply equals high exchange rate. But again, it doesn't mean Kuwait is 3 times stronger than America. It just means its currency is structured differently. This is a common question. Why doesn't Pakistan or India just say 1 rupee equals $1? Because markets don't work like that. If a government artificially raises its currency value, exports become expensive. Foreign buyers stop buying, trade slows, economy suffers. Also, if investors don't believe the price, they'll sell the currency, and the market will push it back down. You can't force trust. You have to earn it. Some currencies float freely, like the US dollar. Their value changes every day based on supply and demand. Others are fixed or pegged. For example, the Saudi riyal is pegged to the US dollar. That means Saudi Arabia promises to maintain a fixed exchange rate. To do that, they must hold massive dollar reserves. Pegging creates stability, but it also limits flexibility. Floating creates freedom, but it also creates volatility. Every country chooses its system based on strategy. The US dollar is the world's reserve currency. Most global trade is priced in dollars. Oil? Dollars. International loans? Dollars. Global reserves? Mostly dollars. This creates constant demand, and constant demand keeps the dollar strong, even when America has debt, even during crises, because the world still trusts it. Let's simplify everything. A currency's value depends on supply and demand, trade exports, interest rates, inflation, political stability, global trust. It's not about pride. It's not about numbers. It's not about ego. It's about confidence. Money works because we believe it works. And when that belief weakens, so does the currency. Next time you travel and you exchange $100 and you see a huge stack of foreign cash, remember, you're not rich, you're not poor, you're just seeing economics in action. Different numbers, different systems, different trust levels, same global game. Because in the end, currencies don't have value. Trust does.